I want you to look at the chart on your screen right now. Do not look at the price. Look at the line. Look at that massive vertical line sticking up from the top of the candle. That is not just a line. That is a crime scene. The price of silver flashed to $83.71. It didn't just drift there. It teleported. 1 minute, we were at $79. The next minute, we were at $83. And then, just as fast as it happened, the rug was pulled. The price collapsed from $83.71 all the way down to $74.47. That is a $9 swing in a single trading session. If you are a new investor, you are probably terrified. You are looking at that drop and thinking the rally is over. You are thinking the bubble has burst. But if you are a veteran, if you have survived 1980 and 2011, you know exactly what this is. This was a stop hunt. This was a calculated algorithmic attack designed to wipe out the leverage traders who chased the gap on Sunday night. The banks saw the liquidity drying up during Ghost Week. They saw the order book was empty, so they let the price run to $83 to suck in the retail money. And then, when the trap was full, they slammed the door. In this emergency market analysis, we're going to dissect the anatomy of this $9 swing. We're going to look at the shooting star candle that is forming on the daily chart. We are going to explain why this volatility is actually healthy for the long-term trend, even if it feels like a heart attack right now. And most importantly, we're going to show you why the physical price of silver did not drop $9 today. The paper market is whipping like a flag in a hurricane. But the flagpole is rock solid. This is the story of the Monday rug pull. To understand why silver dropped from $83, you have to understand who bought at $83. It wasn't the smart money. The smart money bought at $30. They bought at $50. The people buying at $83 on a Sunday night gap open were the chasers, the FOMO crowd, the people using 10 times leverage because they wanted to get rich quick. The banks have a database. They know exactly where these traders put their stop-loss orders. A stop-loss is an automatic sell order that triggers if the price drops. Most people who bought at $80 put their stop-loss at $75, so the banks engineered a drop. They sold a massive block of futures at the high. This pushed the price down. It hit 79, then 78, and then it hit the stop-loss zone at 75. Snap. Thousands of retail sell orders fired at once. This created a cascade, a waterfall of selling. The price plummeted to $74.47 solely because of forced liquidations. And guess who was waiting at $74 to buy it back? The same banks that sold it at 83, they sold high. They forced you to sell low, and then they bought your position at a discount. This is called rinsing the leverage. It is brutal. It is unfair. But it is how the market clears out the gamblers before the next leg up. Now, let's look at the chart pattern. Technically, this candle is called a shooting star or a high wave candle. It is a small body and a very long upper wick. The wick represents rejection. It means the market tried to go to $83, but the sellers pushed it back down. Usually, a shooting star signals a pause. It means the buyers are exhausted. They ran up the hill and they are out of breath. We should expect the price to consolidate here. We might chop around between $75 and $80 for a few days. Do not expect another straight line up tomorrow. The market needs to digest this $9 meal. But here is the critical data point. Look at the closing price relative to Friday. We closed Friday at $71.91. Right now, we're trading around $78.36. Despite the crash from the highs, we're still up. We're up nearly 10% from last week's close. If you ignore the wick, if you ignore the $83 flash, this is still a massive green day. The trend is still up. The breakout is still valid. The only thing that changed is that the easy money phase is over. Now we enter the volatile grind. Let's talk about gold. Gold is trading at $4,514. It is down slightly, about $4. This is stability. While silver is whipping around like a wild animal, gold is sitting calmly at all-time highs. This tells us that the monetary system is still broken. Gold is the anchor. As long as gold holds $4,500, the floor under silver is secure. Silver is just acting like the high beta sibling. It overshoots to the upside, and it overshoots to the downside. This volatility is the price of admission. If you want the gains of silver, you have to stomach the swings of silver. If you panicked when it dropped to $74, you were over-leveraged. Physical holders didn't panic. Physical holders looked at the screen, saw the drop, and went back to eating leftovers. Because they know that an ounce is still an ounce. Now, we need to discuss the ghost week factor again. We warned you that low volume creates air pockets. Today was the proof. The reason the price could fall $9 so easily is because there were no buyers in the middle. The order book was hollow. The price fell through the gap until it hit the limit buy orders. Of the industrial whales sitting at $75. Notice where it bounced, $74.47. Why there? Because $75 was the breakout level from last week. Old resistance becomes new support. The market tested the breakout. It held. This is technically perfect behavior. It validated the $75 floor. The whales were waiting there. They stepped in and bought the dip aggressively, pushing us back to $78. This confirms that the industrial bid is real. Samsung and Tesla didn't chase the price to $83. They are too smart for that. They waited. They let the banks smash it. And then they scooped up the cheap contracts at 74. Smart money buys weakness. Dumb money buys strength. Today, we saw a transfer of wealth from the dumb money to the smart money. We're going to go deeper into this investigation. We need to look at the physical market reaction. Did dealers lower their prices when spot dropped to 74, or did they keep premiums high? And we need to look at the January setup. Does this shooting star candle ruin the January effect? Or does it simply offer a better entry price for the pension funds? The rug pull was painful, but it cleared the deck. The leverage is gone. The weak hands are gone. Now, the real market can resume. Stay tuned as we continue this deep dive. We are going to check the pulse of the physical supply chain. Do not let the volatility shake you out. We need to talk about the physical disconnect. While the paper price was crashing from $83 to $74, what happened at the coin shop? Did the dealers lower their prices by $9? Did they say, oh look, the comics crashed, let's sell silver cheap? No, they kept their prices exactly where they were. In fact, some of them raised their premiums. This is the single most important signal for the physical investor. The spot price crashed, but the street price held firm. Why? Because dealers know that the paper volatility is fake. They know that if they sell a silver eagle at $78 and the price snaps back to $83 in an hour, they lose money. They're not willing to play the volatility game with their physical inventory. They are treating the physical metal as a stable store of value, while treating the paper price as a broken casino. So if you were waiting for the dip to buy physical, you probably missed it. The window to buy at $74 was open for maybe 15 minutes. And even then, the websites were likely crashing or showing out of stock. This proves that the dip was a paper event, not a physical event. There was no flood of physical selling. There was no line of people trying to dump their bars. There was only a computer algorithm dumping futures contracts. This divergence is critical. In a real bear market, physical investors panic sell. In a manipulated stop hunt, physical investors hold tight. We saw holding, we saw strength. The foundation of the market is solid concrete, even if the roof is shaking in the wind. Now, let's look at the industrial reaction. We talked about the whales buying the dip. Imagine you are the procurement manager for a solar company. You need silver. You have a budget. You saw the price hit $83 this morning. You were terrified. Then you saw it drop to $74. Did you panic? No, you celebrated. You hit the buy button on your hedging software instantly. This $9 drop was a gift to the industry. It allowed them to secure inventory at a discount before the end of the year. They used the bank's manipulation against the banks. The banks smashed the price to clear out the speculators, but they accidentally gave the industrial users a cheap entry point. This is why the price bounced so hard from $74 back to $78. The industry stepped in. They absorbed the paper selling and turned it into physical delivery requests. This creates a higher low. Last week, the floor was $65. This week, the floor looks like $74. We are building a staircase. The steps are getting steeper, but the direction is the same. Up. Let's discuss the volatility tax. Volatility is a tax on leverage. If you are trading futures or options or margin, today wiped you out. You paid the tax. But if you hold physical, you paid nothing. Your ounce is still an ounce. In fact, you gained information. You now know that the market is capable of hitting $83. You have seen the potential. The flash to $83 was a glimpse of the future. It showed us where the price wants to go when the suppression lifts for just a moment. It was a price discovery preview. Think of it like holding a beach ball underwater. For a second, the grip slipped and the ball shot up to 83. Then the banks wrestled it back down to 78. But now we know how much energy is stored in that ball. We know that 83 is not the ceiling. It is just the first stop. We also need to look at the currency crosses. Silver didn't just crash against the dollar today. It crashed against everything. And then it recovered against everything. The dollar index is relatively flat. This tells us the move was specific to silver. It wasn't a macro event. It wasn't a change in interest rates. It wasn't a peace treaty. It was purely internal market structure. Positions were too heavy on the long side. The boat tipped over. Everyone fell out. Now the boat is righting itself. This cleanse is actually bullish for January. If we had gone straight to $100 without a correction, the crash would have been devastating. It would have ended the bull run for years. By crashing now, by flushing the leverage now, we reset the open interest. We clear the decks for the new money coming in January. The pension funds we talked about, they are happy. They didn't want to buy at 83. They are happy to buy at 78. The market just made itself more attractive to institutional capital. Let's analyze the psychology of the wick. That long wick on the chart is scary. It represents rejection. Technically, it means sellers overpowered buyers at $83. This creates a resistance zone. For the next few days, $83 will be a tough nut to crack. Traders who bought at the top are now bag holders. When the price gets back to 83, they will sell to break even. This creates a supply overhang. So do not expect us to break $85 tomorrow. We need to chew through that overhang. We need to consolidate. We need to trade sideways between 75 and 80 for a while. We need to let the moving averages catch up. This sideways chop is the most difficult market to trade. It is designed to bore you to death. The volatility will drop, the excitement will fade, and that is exactly when the next move will happen. But there is a wild card. Gold. Gold is trading at $4,514. It barely moved. It didn't flash crash. It didn't spike. It just held. This stability is the anchor. If the silver market was truly broken, if the bull run was over, gold would have crashed too. The fact that gold is holding $4,500 tells us that the monetary premium is still there. Silver just got a little ahead of its skis. It ran too fast. Gold is the adult in the room saying, "Calm down, kid. We are going higher, but not that fast." Look at the gold to silver ratio. At $83, the ratio dropped into the 50s. At $74, it went back to 60. Now, at $78, it is around 57. We are compressing. The trend of the ratio is still down. This means silver is still outperforming gold. Even on a crash day, silver is showing relative strength compared to where it was a week ago. Last week, we were celebrating $65. Today, we are disappointed with $78. That is a change in perspective. That is the wealth effect playing tricks on your mind. You're disappointed that you aren't richer, faster, but you are still rich. Let's talk about the bank solvency rumor again. We mentioned the Lehman moment. Did a bank blow up today? The 10% swing suggests someone was in trouble. The crash from $83 might have been the liquidation of a long fund that got too greedy, or it might have been the desperation short of a bank trying to defend the $80 level. If it was a bank defending $80, they spent a lot of ammo. They burned a lot of paper contracts to push that price down $9. They added to their short position. They dug the hole deeper. They saved themselves for one day. But they increased the explosive potential of the next rally. They kicked the can. But the can is getting heavier. Now, let's look at the volume profile of the drop. The volume on the way up was massive. The volume on the way down was high, but panic-driven. Usually, panic selling is short-lived. It washes out quickly. Structural buying is long-lived. It lasts for months. The buying we saw at the open, the buying we saw at the dip. That is structural. The selling was tactical. Structural beats. Tactical in the long run. So, what is the strategy for the rest of Ghost Week? We have 3 days left until New Year's Eve. Liquidity will remain thin. The rug pull we just saw could happen again. We could see a flash to $70, or a flash to $85. The random walk theory is in full effect. Without the adults, the kids are throwing chairs. Your job is to stay out of the crossfire. Do not put stop losses in the system. If you have a stop loss at $74, you got taken out today. You sold the exact bottom. And now you're watching it trade $4 higher. That hurts. The only way to avoid that pain is to remove the stop loss. Trade small enough that you don't need a stop, or hold physical, where stops don't exist. We need to prepare for the monthly close. Wednesday is December 31st. The monthly candle closes. The yearly candle closes. If we close the month above $75, it will be the highest monthly close in history. It will print a massive green candle on the yearly chart. This sends a signal to the pension funds for 2026. Silver is the winner, even with a wick. Even with a rejection at 83, a close at $78 is a triumph. It seals the deal for the January effect. So do not let the intraday violence blind you to the inter-year trend. The year is ending on a high note. The volatility is the noise. The price level is the signal. We are trading near $80. If I told you that a month ago, you would have said I was crazy. Now, you're disappointed it isn't 90. That is progress. In the next section, we will look at the January setup. We will analyze how the shooting star candle affects the algorithm's decision to buy next week. Does it scare them off, or do they see it as a discount? And we will give you the end-of-year checklist, what you need to do before Wednesday to ensure you are ready for the tax year turnover. The rug pull was a test. You passed. Now let's get ready for the graduation. We need to get inside the mind of the machine. The financial markets are dominated by algorithms, specifically commodity trading advisors. These robots control hundreds of billions of dollars. And right now, they are looking at that shooting star candle on the daily chart. And they are recalculating. To a human, a shooting star looks like a failure. It looks like the price tried to fly and got swatted down. But to an algorithm, it looks like volatility. Algorithms hate volatility. When the price ranges $9 in a single day, the risk metrics explode. The machine thinks the market is unstable. We need to reduce position size. So, over the next 48 hours, we might see the algorithms stop buying aggressively. They might step back. They might let the market drift. This creates the chop zone. We're likely to see silver bounce between $75 and $80 like a ping pong ball. Up $2, down $2, up $1, down $3. This chop is designed to kill option traders. It destroys the time value of call options. It frustrates the momentum traders who want instant gratification. It is the spin cycle of the washing machine, cleaning out the excess leverage before the clothes are dry. But here's the secret. The algorithms are short-term thinkers. They look at daily volatility. The pension funds, the ones coming in January, are long-term thinkers. They look at monthly trends, and the monthly trend is vertical. When a pension fund manager looks at today's drop, he doesn't see a shooting star. He sees a discount. He sees that silver was $83, and now he can buy it for $78. He just saved $5 an ounce on a billion-dollar position. That is a win. So the rug pull actually increases the probability of the January effect. If the price had stayed at $83, the funds might have hesitated. They might have thought it was too extended. But at $78, it looks like a bargain relative to the high. It creates a buy-the-dip mentality for the institutional capital. The crash cleared the runway for the heavy jets to land. Let's talk about the